Hello everyone, I'm GL and I'm here to enrich lives and values. I help people boost their financial savvy as we navigate the fundamentals, unravel the underlying logic and concepts of investment, finance, and accounting. We also delve deep into actionable insights so that everyone can be a greater self. Welcome to today's lesson on a topic that affects many investors: keeping emotions out of investments. Before we begin, let's together we take a deep breath. 3, 2, 1. Breathe in. Breathe out. One more. Breathe in. Breathe out. 3 more. Breathe in. Breathe out. Tell yourself, stay cool, keep calm, I am good. Feeling good? Let's dive in. Investing can be challenging and brings an emotional roller coaster experience. Very often, our feelings can cloud our judgment. We then make poor decisions. We miss the opportunities in the market. Be mindful that the market sentiment may influence your emotions and risk your financial losses in your investment decisions. Let's talk about the power of having a clear mind when it comes to making better decisions for investment. When you approach investing with a clear mind, free from distractions and emotional biases, you are able to make more rational and informed decisions. Next, let's talk about the importance of good discipline when making investment decisions. See, having disciplined stamina means having emotional stamina. Sticking to a plan, staying focused on long-term goals, and avoiding impulsive decisions. It is like laying a solid foundation for your financial future. When you have consistent discipline with stamina, you are more likely to survive market fluctuations and ultimately achieve your investment objectives. So remember, whether investing in stocks, unit trust funds, real estate, or anything else, good discipline with stamina is the key to success. What about emotional distance? What do you know about emotional distance? How critical when it comes to decisions making for investments? Emotional distance is the ability to make decisions without being distracted by emotions. Emotions such as fear, greed, and overconfidence can cloud your judgment and very highly likely lead to irrational investment decisions. Well, let me break it down for you. See, when you are emotionally attached to an investment, like maybe it is a company you love or a product you are passionate about, potentially it can cloud your judgment. But by maintaining emotional distance, you can make more objective, rational decisions based on the underlying logic, research and analysis rather than emotions. So, next time, remember to keep your emotions in check and think with a clear head before decisions. This approach can help in achieving long-term financial goals while minimizing the impact of market volatility on investment portfolios. Therefore, emotional distance can be an important aspect of making sound investment decisions. Now, Let's explore some of these emotional pitfalls, and then I will share with you some strategies to overcome them. You actually can become a more rational, vigilant, successful investor, but only when you're in full control of your emotions. So, let's find out. First case, let's take a look. When the market goes up, when the share price goes higher, your confidence boosts. And you know what? You invest even more and more. But this could be a false sense of security. Second case, who knows? Things happened in a split second. The market starts going down, the share price starts going lower, and your confidence is lost immediately. You see your investment is shrinking fast as the market fluctuates. And you know what? You panic and start selling as you try to protect your capital before the market crashes further, fearing that the share price will go down even lower than ever. You are supposed to buy low and sell high to make money. Surprisingly, you did exactly the opposite way. You bought high, but you sold low. Unbelievable. You accumulated massive losses as a result. You were shocked and fainted straight. Unbelievable. Market sentiment may influence and distract your emotions, causing you financial losses. Potentially, you might accumulate massive losses over time. Even worse, you repeat the mistakes until you are financially broke. You are emotionally trapped and fail to keep emotions out of investment. Take a deep breath and start again. Don't worry, be happy. Telling yourself, stay cool, keep calm, and I'm good. Don't worry, be happy. I have 5 strategies to share with you to help you keep emotions away from the investment decisions making process and get your emotions under control. Strategy number 1. You should have an investment plan designed to make your money work hard towards your ultimate financial goals. The investment plan that will keep you focused on your long-term goals, even though the market conditions can be challenging at times and influence your emotions. You should ignore the market volatility, just stay focused and keep going. Make sure your investment plan has a longer investment horizon with a period of more than 5 years and beyond. Provided that the underlying securities of your investments are fundamentally strong, fundamentally sound, and fundamentally solid, you should take the opportunity to invest more at a cheaper valuation, which means you should grab the advantage of quality investment whenever the prices are attractively low. I repeat, whenever the prices are attractively low, quality investment. Stock that are undervalued, I mean good stocks, quality stocks that are undervalued can be a good investment for the right price at the right time. So, please do your study and homework well enough beforehand. Strategy number 2. Diversify your investments. Always ask questions to check and remind yourself whenever you review your investment. The question is, do I put all my eggs in one single basket? No one should concentrate all efforts and resources in one area, as you could risk losing everything if the worst case happens. I mean, you have to make sure your investment does not depend on one type of asset class, sector, or market. Best possible to diversify your portfolio that could help you ride through different market cycles smoothly. Ensure your target allocation includes a fairly diversified mix of asset classes to spread risk effectively. Strategy number 3. Invest in good and bad times. Take the advice to invest a fixed sum regularly, let's say every month, regardless of market conditions, be it good or bad, just like you are doing regular savings in a bank account. Regular investment will indeed help you average down your investment costs over the long term. This is how you optimize your returns on investment. Trust me, it is surely a worthy decision to take on. Strategy number 4, which I have repeated multiple times. Do not get distracted by short-term volatility, short-term fluctuation, and just focus on your investment objectives. Equally important is that you have to understand and invest based on your risk tolerance. It will be good for you to review and rebalance your investment portfolio when the market outlook changes. Let's say if the outlook for the equity market turns unfavorable, then the exposure of equity-related securities may be reduced, while the exposure to more liquid assets, which include bond funds, let's say, money market instruments and deposits, may be increased as a temporarily defensive strategy. By staying on top of these shifts, you can ensure that your investments are aligned with your goals and risk tolerance. So, keep an eye on the market. Take good care of your investment and don't hesitate to make proper adjustments to keep your portfolio in tip-top shape. Strategy number 5. Seek appropriate guidance. Getting objective advice from professionally responsible and competent professionals can help you stay on track during challenging market conditions. Sometimes, advice from caliber professionals can be truly valuable and insightful. However, be reminded and be mindful that your investment decisions should be based on fact-check information, not unverified rumors. I repeat, not unverified rumors. Take my word for it. Be a well-prepared investor. Be a rational investor. Be a vigilant investor. Be a value investor. Be a savvy investor who knows the risk and always check emotions at the door. Do not waste time and effort predicting the unpredictable. When you know you simply cannot afford the extent of risk due to uncertainties. Instead, learn how to proactively deal with risks and returns and align them with your mission and goals. Build a more sustainable fortune to live the worry-free and rich life you have long desired. In short, know what you want and, more importantly, know how to get there. Thank you for watching and hope you learned something worth your time from the video. If you enjoyed the video, don't forget to give it a thumbs up, share with your friends, and subscribe to my channel for more content like this. Your support means the world to me. Hashtag like, share, subscribe. Thank you, and I'll see you next time.